Hello, my name is Jin Choi and I'm the founder of Money Geek, and welcome to the 11th episode of the short course on investments. And today we're going to talk about registered retirement savings plans, also known as RRSPs. Simply put, an RRSP is a tax vehicle where if you put money into the RRSP, the government treats it as if you haven't earned that income for that year. For example, if you earned $50,000 in one year, and if you contributed $5,000 into the RRSP, the government will tax you as if you had only earned $45,000. You can buy the usual set of financial assets inside an RRSP, including stocks, bonds, and ETF. And while your investments are inside an RRSP, you don't have to pay any taxes on your investments. In other words, you don't have to pay any capital gains taxes, tax on interest, or on dividends. However, when you take money out from an RRSP account, whatever you take out will be considered income for you and will get fully taxed. So, for example, if you withdraw $10,000 from an RRSP account, the government will treat it as if you earned $10,000 more on top of whatever else you have earned that year and tax you accordingly. So now let's use a hypothetical scenario that we introduced in the last episode and track our pre-tax income when we invested using an RRSP. So as before, let's say that you earn $60,000 and you earmark $6,000 of that pre-tax dollars for investments. And this time, let's say that you use an RRSP, so you contribute $6,000 into it. In this case, the government doesn't tax the $6,000. And let's say that the investments inside the RRSP grows at the same rate that we have done in the past episode. So let's say that we are able to double our investments in 10 years' time. And let's say that we withdrew the money once it doubled. Also, as in the case of the last episode, let's say that your marginal tax rate when you withdraw this money is 34%. And that means that when all is said and done and you pay your taxes, you would have been left with $7,920. Now, if we look back at the previous episode where we had not used an RRSP, but instead used a non-registered account, we were left with $8,235. In other words, it would have been better for us not to use an RRSP at all. This happened because the marginal tax rate in the future, which is 34%, was higher than the marginal tax rate of today, which is 25%. Now, in general, unless you expect your tax rate to go much higher in the future, it is advantageous to use an RRSP. However, in cases where your tax rate today is very low and you expect it to go much higher in the future, it may not make sense to use RRSPs, at least today. That said, there are a couple of other things you should be aware of before you decide to contribute to an RRSP. First, when you hit a certain age, which is 71 right now, the government will force you to convert your RRSP into a registered retirement income fund, or RIF for short. And once the money is inside the RIF, you will be forced to withdraw a certain percentage of that money every single year. Secondly, if you're a first-time home buyer, you can withdraw up to $25,000 from your RRSP tax-free in order to help buy your home. However, if you do this, you will have to recontribute the amount that you withdrew within 10 years back inside the RRSP. So that's what an RRSP does. So let me talk briefly about how to practically use an RRSP. You can open up an RRSP account with a bank or with a discount brokerage like Questrade or virtual brokers. And I personally recommend going with a discount brokerage over a bank, primarily because of the cost. It's cheaper to go with a discount brokerage. But also, there's also the fact that banks typically try to push products like GICs onto your RRSP. So that's another reason to avoid them. There's also a maximum limit that you can contribute into an RRSP. And that limit differs from person to person, and you can find that information in your last year's tax returns. And that's what I had to say about RRSPs. So let me briefly recap what we learned today. we learned that RRSPs allow you to defer your income taxes by the amount that you contribute. And while your money is inside the RRSP, you can grow it without having to pay any taxes on investments. But when you take money out of the RRSP, you have to pay the full marginal tax rate. Generally, using an RRSP account will save you on taxes. However, if you think that your tax rates will be much higher when you take out money from an RRSP, you're actually better off not using it. You can set up an RRSP with a bank, but I recommend going with a discount brokerage instead because it is cheaper. So that's it for today. In the next episode, we'll talk about tax-free savings accounts. So thank you very much for watching, and I hope you have a great day.